The most important thing, I'll start with a quick review. I'll give this book 4 stars. I almost gave it a 5 stars, so I quite enjoyed the book. It's a good review about investing. If you're interested in investing, I highly recommend. I wish I read that book years ago when I started investing. But even if you're not investing, it's a really good, interesting dive in about investing. The reason it doesn't get a 5 because some of the part of the book were not as good as the others, but it almost got a 5. I really enjoyed the book, definitely one of my favorites. And it's a short book, it's not too long, straight to the point, not much extra wishy-washy stuff. So I quite enjoyed it. Let's see the notes. Second level thinking is thinking why everyone are wrong. That's what we need to do when we invest, and do second level thinking, which is like think of next step ahead, like in chess. 2 types of investing: growth, which is looking into the future, and value, which is looking for a cheap price. So there's those 2 types. Growth, that's the future, where it can come from, and value, which is what's cheap. In general, in the book, I'll add a note on the side, I felt like the author is promoting his own company. He has, like, I forgot, Oak Tree or something like that, because he said like everything you're supposed to do, he's already doing. So that part, maybe that's another reason I gave it a 4, because it's like I felt like there is kind of a selling points, which I didn't appreciate. The efficient market hypothesis claims that all stocks are correctly priced. In order to find value, we need to know something others don't, take a risk, or look in unpopular places. So that's the efficient market hypothesis, which is mostly correct, that everything is mostly correctly priced, unless, that's what he adds, unless we take a risk, we know something others don't, or we look for unpopular places. So there, the efficient market hypothesis basically doesn't work as intended or as advertised. Averaging down is buying stocks when they go down in order to have lower average. So when the stock goes down, when we buy more, that will be called averaging down. People like stocks when they go high, regardless of fundamentals. This is how bubbles form. The psychology is highly important. When they go up, more people pile into it, and they don't care about the fundamentals. Psychology, therefore, is really important. So understanding where the market goes and the psychology of people in the market is highly important to understand. Risk-adjusted return is how much risk taking in relation to the return. That's risk adjustment returns, how much risk we take in comparison to the return, or in relation to the return. More risk doesn't guarantee more returns. So if we buy something very risky, it doesn't mean that there is greater returns. It doesn't always work like that. Due to the nature of risk, it's hard to calculate and quantify it. Risk is it's kind of a mystery in some way. It's really hard to quantify and calculate risk. It's something worth noting or knowing. Risk aversion is down, which causes interest rates to not reflect true risk. So interest rate on returns, the interest on the returns, because risk aversion is down, people don't care that much, or they looking more for risk. Therefore, their interest rate on a specific asset, for example, does not reflect risk, because people take risks. When everyone think something is risky, price go down in risk as well. When everyone thinks something is not risky, price goes up in risk as well. So when everyone thinks something is risky, will price go way down. And risk as well, because in those prices it's not as risky. When everyone thinks something is not risky, price goes way up, and risk with it, because it doesn't price correctly and there is more risk. Risk only materializes when things doesn't go as planned, only when the black swan, sometimes they call it, only then risk materializes. Sometimes you won't see it for years. We need to control risk, not avoid it altogether, because that's where the returns are. So if we avoid risk at all, we have very low returns, if at all. So we have to take control on risk. Take risk, but controllably. Too much money causes too much cheap lending, which might default, so on until there is a collapse. Well, the reason why there was that 2008 collapse, too much lending, cheap lending, low interest rate, caused some of them to default because bad money goes places, and so on until there is a collapse. Markets, just like a pendulum, barely spend any time in the mean or in the middle. Most time is spent in extremes. So go from here, from up to down, or from right to left, as if it's a pendulum. And it doesn't have much time in the middle, so we need to know that. It will go up and down. There's the average, but it always go, it doesn't stay in the mean. In times of success, people forget about risk. In times of chaos, people don't want to take, to bear any risk regardless of returns. So in time of success, people piling on risk. So it's the idea that he says a few times in the book, and it's important. In times of chaos, people don't want to take any risk regardless of returns. Therefore, you can find very good investments when everyone are freaking out. What the wise does in the beginning, the fool does at the end. Maybe one of my favorite ideas and quotes from the book. What the wise does at the beginning, the fool does at the end. Doesn't need much explanations. It's great as is. It takes more time for air to get into the balloon than going out. So when the balloon, you need to like inflate it. Sometimes it takes much longer than if it bursts. It goes out very quickly. Similar to markets. If there is a collapse, if there is a bubble, it will collapse very quickly, even though it could take years for the bubble to form. Successful investors are often lonely as contrarians because they take different, or their second level thinking, for example, they take different view, they see things differently, so oftentimes they are lonely because they also take that contrarian view. A bargain could be found where investors dislike an asset which makes it cheaper. Assets that he has a few examples, but when investor doesn't like an asset, that's where we can find good assets, good investments. Waiting for opportunities instead of pursuing them will lower their price. Because when we're pursuing something, even if we trying to buy a company, we're trying to buy assets, which we're pursuing something, it's much likely to go up because just the fact that we are getting interest in them makes it higher. We don't have the leverage. But if it comes to us, we have the leverage, price goes down. Thinking we know the forecast makes us more likely to make wrong decisions. So people think when they know what's going on, they're more likely to make wrong decisions. Luck plays a significant role in investment because it's random, life is random, everything is random, so luck is a big factor. Margin for error is a defense strategy that counts error in downturns. It's not as high, but also not as low. So there is the margin of error. If we implement it successfully, the portfolio, for example, will not go as high, but it won't go as low in downturns. A good investor is one that in bad years is still consistent. Has consistent returns, even in bad years. Good years, everyone can have flukes, but the question, what's happening in bad years? Which is another place he said that in his company, they're doing very well. Which is another reason why I deducted a star. Abundance of capital tend to create bad investment, which create bubbles and failures. Similar things. So there is too much capital, there's bad investments, they default, and there's bubbles. Beta is the sensitivity of the portfolio to market movements. That's the beta when they calculate formulas and stuff. It's how much the sensitivity of the portfolio there is for many movements. Alpha is personal skill to create value. So our personal skill, what can we get to the table? So that is for the notes. So like I said, very interesting, especially if you're an investor. Some good points. And yeah, definitely 4 out of 5. Thank you.